Insightful Value opens with a compelling look at why National Healthcare Corporation stock, ticker NHC, is sagging, and whether that low price hides an opportunity. This review is for informational and educational purposes only, not financial advice. Please subscribe and hit like if you enjoy the insights. Today's date is July 27, 2025. National Healthcare provides skilled nursing, assisted living, independent living, home care, and hospice services across 11 U.S. states, primarily in the Southeast. From a value investor lens, the business shows solid operational momentum, but the stock lags due to uncertainty and risk in lease renewals. In the quarter ending March 31st, 2025 revenue grew 25.7% year over year to $373.7 million, driven by an 8.5% increase in same-facility revenue and the acquisition of White Oak Management in August 2024. Adjusted net income soared 61.4% to $24.8 million, earnings per share hit about $2.07, and operating cash flow jumped over 300% to $39.3 million, thanks to sharply lower agency nurse staffing costs. Trailing net profit margin stands near 8.1%, and the share trades at a price-to-earnings multiple around 15 to 16, with price-to-sales near 1.16 and price-to-book close to 1.0. Despite improving fundamentals, the stock is down about 1% year-to-date and volatile over the past 6 months, swinging between the high 80s and low 100s USD per share. Investor sentiment faces headwinds from a high-stakes lease renegotiation with national health investors. Activist Land and Buildings warns that a rent reset could cut NHC's EBITDA by 19 to 38% if terms go awry. That risk clouds near-term earnings visibility and share valuation. Other risks include rising labor costs tied to new federal staffing mandates, the ongoing hospice billing investigation, interest expense pressure, and concentration in marketable securities, nearly 69% invested in related equity. On the positive side, the business benefits from rising occupancy, 89.3%, reliable pricing power in senior care, operational efficiency gains, and a cleaner cost structure due to agency expense reductions. Why now? If management can negotiate a fair renewal lease, maintain margin momentum, and avoid regulatory fallout, much of the downside may be priced in at current levels. But why not now? If lease terms collapse, labor mandates squeeze margins, or investigations result in penalties, the stock may struggle further. In sum, National Healthcare is not distressed. It's growing with strong revenue and cash flow, but it faces binary outcomes around lease contracts and regulations. For disciplined value investors tracking income-generative healthcare businesses facing legal or contractual uncertainty, it could be worth watching, but only if you're comfortable monitoring resolution of key risks. For deeper insights on NHC and other attractive value opportunities, head to InsightfulValue.com, where we translate complex data into actionable takeaways without financial jargon. Thanks for watching. Don't forget to subscribe for more value-focused analysis and visit InsightfulValue.com for additional insights.